So our next presenter, I mentioned at the beginning, we're delighted to have with us today Robert Gardner, who's Chief Economist from Nationwide. This is going to be a fascinating insight into the challenges facing a lender in the coronavirus pandemic. So over to you, Robert.
Thank you. There are four main areas that I'm going to talk about. So firstly, the impacts of the pandemic on the overall economy and what we can tell to date. The policy response, developments in the housing and mortgage market, and then finally how we're approaching forecasting in this very uncertain environment. So first of all, then, what can we say about the impacts on the economy from what we know so far from the pandemic? Well, obviously, we're not all the way through this yet, and the data comes out with a lag. Nevertheless, the scale of the shock to the economy is starting to become evident. So, for example, if we look at output loss, in March alone, the UK economy shrank by almost 6%, and the economy was only in lockdown for just over a week. That's almost a bigger contraction as the economy recorded over the entire financial crisis. And if you look at Q2 in the UK, output loss could easily be another 20% or so, given that the lockdown was for most of that period. And we see this picture around the world. Similarly, if we look at the labour market, again, we see the impact starting to become evident. The US is a good example of just the scale of what we're seeing. The US economy lost about 9 million jobs in a 2-year period during the financial crisis. In the 10-week period from early March this year, around 40 million people registered a first claim for unemployment. So you can see just the scale is on a completely different order of magnitude. Similarly, in the UK, there are about 1.3 million people unemployed, the stock of unemployed people that is in January of this year. And then about 2 million people applied for universal credit in a 6-week period. 25% of the workforce, more than that, in fact, it is now furloughed, 9 million people, and there's another 2.5 million self-employed people that are also being supported by government scheme. So I suppose the difference this time around is that the vast majority of the effects in the economy is due to deliberate policy action taken to control the pandemic, control the spread of the virus. The economy has been deliberately put on ice. So hopefully, as the economy is freed up, that means it can bounce back more quickly. But the way forward is going to be determined to a large extent by how the pandemic itself evolves, and linked to that the measures the government has to take in order to restrict inactivity and so on, but also any behavioural responses by households and businesses. That's going to impact activity as well. And finally, and crucially, the type of recovery that we get is also going to depend to a large extent on any long-term damage that's done to the economy as a result of this shock. And that takes us on naturally to the second area that I was going to talk about, which is the impact of policy and the policy response. Now, much of the policy response is clearly geared towards limiting that long-term damage and that scarring effects on the economy. And there are a few strands that we can separate out in terms of the policy response. First of all, if we think about the monetary response, a lot of that has been designed to try and make sure that the financial sector doesn't amplify the shock and make things worse. So if you look at whether it's the reduction in bank rate, additional asset purchases, liquidity support and funding support schemes, the macroprudential measures, all those are aimed at ensuring the availability of credit to the economy and reducing the cost of credit to try and support activity, households and firms through this difficult period. Same that government loan guarantees are designed towards the same end. Lenders are also trying to do their part, things like payment holidays for borrowers on loans and mortgages and so on. And then we've had a very significant fiscal support put in place, try and support businesses, jobs and people's incomes. So furlough schemes, support for the self-employed, cuts in business rates, grants, all these things. Now, clearly, the fiscal cost is going to be enormous, could easily be 15% of GDP, the budget deficit this year, and that compares with about 10% at the worst point in the financial crisis. I think there's a few important things to say about that, because government debt is also going to rise sharply, probably above 100% of GDP from the 80% or so we were before the financial crisis. So the first thing to say is that this fiscal response is definitely necessary, and it's going to work out a lot cheaper in the long run than not doing it. The damage that not doing it would cause to people's livelihoods and just the long-term prospects of the economy, it's definitely the best solution in the long run. Can we afford it? Absolutely, yes, we can. The UK economy has had much higher debt as a share of GDP in the past. So say at the moment we were about 80% debt to GDP, public debt, before the pandemic struck. It's probably going to go above 100%. But if you look after World War II, it was over 260%. In the early 20th century, we had 175% debt to GDP for several decades. So it's not by any means something that we haven't experienced before. And we can definitely live with that, and it shouldn't cause significant problems. Similarly, if we look internationally, Japan has a debt to GDP ratio of over 200%. The thing that people worry about in terms of high public debt levels is it will put upward pressure on market interest rates. Again, there's little danger of that in the near term. Japan again shows, as I say, debt to GDP over 200%, and yet they've had negative interest rates, even 5-10-year maturities. So it's not something we should worry about. At this point, the UK is not part of the Eurozone, for example. We have our own currency, and that independent monetary policy gives us greater fiscal flexibility that we should absolutely use to make sure we support the economy as best we can. I think that the most important thing on the fiscal front is to make sure we avoid the mistake of tightening policy too soon. And the reason why that's particularly important is because monetary policy has become less effective because interest rates are already practically at zero. In fact, the risk of negative interest rates is increasing. It's more important, therefore, that the fiscal side continues to provide that support because interest rates are as low as they are at the moment. So turning now to the housing market and the mortgage market. So I suppose the first thing to say there is that the housing market had actually really been starting to pick up and gain momentum before the pandemic hit the UK, whether it was transactions or house prices. We'd seen things edging up. And now clearly things slowed dramatically in April and May as a result of the lockdown and the government advising people quite rightly not to transact during that lockdown period if at all possible. Most recent data is showing the impact of those effects. So, for example, HMRC property transaction data shows transactions down 50% year on year in April. Mortgage approvals were down by even more than that, down 75% more than that, even year on year. House price data also started to show the impact, starting to filter through. So prices fell by 1.7% over the month in May, the largest monthly decline since February 2009. The annual rate of growth slowed to 1.8%, so half the rate that we saw the previous month, which was 3.7% in April. So things starting to filter through. So what happens next is obviously going to depend crucially on what happens in terms of the wider economy, which we're going to come on to in a moment. But worth saying that the pandemic could impact the housing market through a number of different channels. Clearly, behavioural changes and social distancing are going to impact the flow of housing transactions for quite some time to come. But it might also have other impacts that are maybe less obvious. So, for example, we did a survey in May and found that around 15% of people said they were actually considering moving as a result of life in lockdown. A third of people said that they were thinking differently about their home as a result of the outbreak, especially things like the importance of the garden, the need for window space, the importance of the community amenities around them. Another 20% of people said that they'd changed their mind as to what constituted the most important aspects of their home and thinking of changing, making improvements to their home as a result, adding more space and these sorts of things. So it's difficult to say how long lasting some of these behavioural shifts will be, but nevertheless, it's just hints that the impacts could be more wide ranging than maybe you might imagine. Finally, then, how are we thinking about forecasting in this very uncertain environment? Important to say, I think, that at this point, what happens next is not just uncertain, it's essentially unknowable at this point. It's going to depend on how the pandemic evolves, how restrictions and things are eased, behavioural responses, how effective the policy response is, as we've said already. I think what this means is the only sensible way to proceed is really through scenario analysis, where we think about a whole host of different outcomes and what the implications of those would be and be ready to respond accordingly. And we do that by varying some of the key assumptions about, for example, how long the pandemic might last. Will there be one or multiple waves of infection? How severe the knock-on effects will be? And in particular, the policy response and how effective it is in the short and long term at limiting damage to the economy. And only that way, by thinking about all those different outcomes, can we really make sure that we're ready for all the different things that could come next. And it's also important to say it's not going to be clear which scenario we're in until maybe quite a while after the fact. So, for example, we may see a strong recovery begin, but then if there's another wave of infection, we may see activity slow again. So important just to keep in mind the potential for the economy to take different paths forward, and just to keep that optionality, keep that in mind when taking business decisions. And as if things weren't complex enough, just in terms of thinking about the domestic impact of the pandemic and what that could do to economic prospects. Also, other things we need to keep in mind. First of all, that it's not just the UK effects we need to think about. Obviously, global developments are also important. The UK is still a very open economy, and what happens globally is very important. So how the pandemic evolves internationally, how it impacts other countries is crucial. For example, we think about the US and how that's coping. And also, when we think about the US, it's not just because it's such a large trading nation, but also because of its importance to global financial markets. So important to keep an eye on what's happening internationally as well. And also the question of Brexit and how that will pay out. Now, will we see an extension to transition or not? Will we manage to get an agreement before the exit date approaches or not, or rather before the transition period ends or not? And I think that's crucial, because if businesses and households have to cope with an adjustment to WTO arrangements alongside the aftermath of the pandemic, that could be quite difficult to cope with. So important to understand what is going to happen there and how that will play out as well, and keep that in mind. But I'll draw my comments to a close there. Thank you very much for listening.
So thanks, Robert. It's been great to have you here today and providing a fantastic overview of the economy. I think we've got time just for one question. It's clear that from your presentation that there's lots of levers to pull. But in terms of recovery in the house building industry, what for you is the key policy?
Thanks, Neil, and thanks for having me. I think for me, the key thing is really not so much specific measures to support the housing market per se, but making sure that we secure the best recovery that we possibly can. As I said in the presentation, I think key to that is making sure that we don't take away those stimulus measures too soon. We make sure that we minimise the long-term damage to the recovery, and that will ultimately be the best support we can provide for the housing market over the longer term.
Thanks, Robert. That's great. Just to say thanks again for those of you who have completed the poll with regards to the length of time you expect this disruption to last. So there's the majority going for, or 45% going for 1 year. You can see the response we've had to the poll, 258 on the ticker. So I've got to say, you're not watching this by yourself out there, because we know from our production team that there's well over 500 people that joined us for today's event, which is a great response. So thanks for joining us.